All right, we can get started if you'd like. All right, good morning. Thank you for allowing us to join you this morning. My name is Brett Holland, and Mike Battistelli and Sonia Gross with Stifel Financial. We have a guest with us this morning, Chris Allman on behalf of Madison Investments. And we might have Andy Romanovich as well. I'm not sure if he's on. Chris is shaking his head, so somehow, some way, he's going to join us as well. Andy is a portfolio manager, and Chris is a regional investment director. Madison Investments, they manage medium-sized companies on behalf of the pension and represent about $2.5 million of the overall pension in their piece. They have companies like CarMax and Dollar Tree and Progressive Insurance, companies like that I'm sure they'll talk more about here in a few minutes. But just to kind of get started in our typical fashion, we have the report, and I believe everyone hopefully has that with them there. And we'll go to page 1, if you would, there in the bottom right-hand side, where we have the pie chart in the bottom left-hand side and the bar chart in the top left. And we'll just kind of start as we typically do, go from the top on the left and move our way across the page. So the combined portfolio, and this is ending, again, December 31st is what it is. So this is a year-end report. For the quarter, the portfolio was up 7.59%. And then for the year, a year-to-date number was 9.31%. So that was also obviously a 12-month number is what that was. And Mike will, again, have updates as to the last day or so here in a minute. Over to the right there, under the quarterly, under that line chart, beginning market value at the beginning of the quarter, which would have been October 1st, was $131,297,201. And during the quarter, we had withdrawals of $2.1 million and capital appreciation of about $9.8 million, leaving the overall portfolio at the end of the year at $139,078,346. And the next column to the right of that is just the 1-year numbers, if you will. We started the year January 1st of last year at $132 million. Throughout the year, there were withdrawals. There's a net number of between deposits and withdrawals of $5.2 million of withdrawals out of the pension. The capital appreciation during that time was $11.7 million over the 12-month period, and then again ending at the end of the year at that $139 million number. So any questions with any of that at all?
No, just the inception number has come a long way.
It has.
Yeah, it's much healthier. Yeah.
Yes. To the bottom left-hand side where that pie chart is, we always like to talk about asset allocation. Showing your equities there or your stocks of 67.71%. And we always remind you that we try to break the REIT portfolio, that real estate investment trust, try to break that out so you can kind of see the difference. So just pure stocks, the equity portion is 63.87, and the REIT portfolio is 3.84 is what it is. Fixed income, 28.52, and the cash portion is 3.7% is what that is. That equity portion, Mike's going to talk about that. We had pulled some of that out last year and kind of rebalanced, and he's going to talk a little bit more about that here in a moment as well. And then the last thing, just to kind of follow up from our last quarterly meeting, we had talked about the investment policy statement. We just like to update that each year and didn't know if there were any changes that were recommended by the board at all.
We've not discussed any, to my knowledge.
Okay. If it's okay with the board, what we'd like to do is we'd like to drop off a clean copy, and then maybe have, as we do each year, just have everyone sign off on it, and that way you have it for your records, and we'll have a copy for our records as well.
Okay.
All right, very good, thank you. And now Mike's going to pick up and kind of give an update through the last day or so.
So just kind of going forward here, starting in January, and this is actually through Tuesday. the balance now stands at $141,267,158. And again, unaudited, unofficial performance numbers, we are up about 2.25% year to date. So off to a reasonable start halfway through the first quarter. Our equities, again, have continued to grow from what Brett reported year end. Just again, the equity piece pulling out the REIT portion. The equity portion now stands at 64.53%. Our investment policy statement, if there's no changes to that, does say the upper end of the equity range is 60%. So we're actually going to recommend that we reallocate some of the equities and actually move it to cash. And what that'll do is allow us cash reserves for the next 6 months or so for distributions out of the plan to pay the retirees. And it represents about 3% of the portfolio. We would be taking $2 million from Legg Mason, which is large cap growth. There seems to be maybe a little bit of shift from growth, favoritism in growth versus value stocks. So we're taking a little bit more from growth. So it'd be $2 million from Legg Mason, $1 million from Dearborn, $1 million from Washington Crossing Advisors, and $250,000 from CS McKee, the equity portfolio. Again, we just move that over to cash, and that'll cover the next 6 months worth of distributions for you.
Okay. All right. Thank you, Michael.
Sure. Any questions on the updated numbers or the reasons why we're reallocating?
I have none. I'm going to move on to Christopher. Is that the plan?
Sure, that'd be fine. So Chris Allman and Andy Romanovich, again, they're with Madison Investments, and they're going to share, just to give a little background too, about a year ago, they've only been with us for about 12 months, and they've been a great addition to the overall portfolio. So with that, Chris and Andy.
Morning.
I think Chris is on mute. Or turn off the volume or something.
Andy, you may have to fill in for a couple minutes.
Yeah.
Sure. Yeah, be happy to. No luck, Chris? Okay.
All right.
All right, well, I'll fill in. Yeah, so I appreciate you guys having us on the call this morning. We're happy to help out in any way we can. I can provide kind of an overview of the equity markets in our portfolio and kind of what we're seeing from our perspective. Talk a little bit about performance and what we've been doing in the portfolio, kind of keeping it at a high level. But please feel free to interject with any questions you may have at any point when we make sure you get the most value out of it. And Chris, if you figure out your volume, feel free to interject anything you need to. So we've just started off on the market environment. Kind of fourth quarter, is really, and into this year is really what we call a risk-on environment. So it's really an environment where markets are doing very, very well. And if you kind of look underneath the hood a little bit, it's a lot of the more riskier assets, a lot more riskier equities, that are doing really well. So, companies that have, more aggressive balance sheets, businesses that might be in secular declining industries, companies that have traded very high valuations, more cyclical businesses. These are the types of stocks that are doing very, very well. And as you can see in the fourth quarter, the Russell Midcap Index was up about 20%. And that's rare. In the last, we look back the last 20 years, so 80 quarters, there was only 14 quarters where the Russell Midcap was up over 10%. And for our style specifically, that generally provides somewhat of a headwind. We're very risk conscious investors. We look at both return and risk. We're very sensitive to valuations, very sensitive to quality balance sheets, quality businesses, sustainable growth. So it's typically more of a headwind for us. And in fact, we did underperform in the quarter, which is pretty consistent with how our strategy has performed in these kind of risk on markets. For example, in those 14 quarters where the Russell Midcap was up over 10% in the last 20 years, we've underperformed in 13 of them. And it just so happened that 4Q20 was one of those quarters, and actually 2Q20 was also another one of those quarters where the Russell Midcap was up 25% in that quarter. So we're really seeing this in this environment. Another way to kind of different angle at this is to look at more indices from Russell, where they actually have a Russell Midcap defensive benchmark and a Russell Midcap dynamic benchmark. And as the name implies, the defensive benchmark has more of the steadier businesses, more of the lower beta, kind of higher returns on invested capital businesses, while the dynamic benchmark has the opposite, right? Higher beta, more speculative in nature, higher debt level businesses. And the performance there has been pretty amazing. So the dynamic benchmark in the fourth quarter outperformed the defensive by almost 1,000 basis points. It's up about 22% versus up about 12% in that period. So that's a huge spread. And if you look into what's kind of continuing to this year, you're seeing a lot of the same stuff, right? You're seeing a huge spread between dynamic and defensive performance. You're kind of seeing what I described in the fourth quarter, just continue just on a little bit more severely so far year to date. So a lot of stocks with, you probably see them in the headlines, right? A lot of stocks with high short interest are doing extraordinarily well. A lot of, we look at this to get a gauge on this. Goldman Sachs has a really interesting index called their retail favorites. It's kind of the hot stocks, the message board stocks. These stocks are up over 40% over the S&P. So you're just seeing there's a lot of money in the economy right now, a lot of stimulus flowing. A lot of that money is finding itself into Robinhood accounts and other types of retail accounts, and really chasing a lot of these kind of hot stocks. And not as much of an environment that's focused on risk.
Hey, Andy.
Yes, Chris.
So I have my volume working. I apologize for that earlier. But I did want to say, Andy, what Michael was saying, alluding to earlier, was the transition that they were moving the portfolio from growth to value. If you can focus a little bit on the discussion of saying why that actually is exactly how we think some of the valuations of these growth stocks have grown exponentially, and why it's a little, I don't want to say the word scary, it's just a little nervous, and why our portfolio doesn't look at names like that. So again, it coincides with what you're saying, but I want to make sure that it lumps in with what Michael was alluding to earlier. So go ahead.
Yeah, absolutely. So that's a great point. The way we approach this is we're bottom-up investors. We're really true stock pickers. We really are people that really try to understand the businesses first. We kind of invest like we're investing in a business, not investing in the stock market and plain stock market. So we really let that type of mentality drive what we do in the portfolio. So really bottom-up perspective. And what we're seeing from the bottom up is more value on the value side of the market. And so that's kind of where we've been hunting, and that's where most of the portfolio activity has been. To Chris's point, a lot of, and what I was saying before, a lot of the risk on and a lot of the gains in the market have been in more of these higher growth, really high valuation stocks. And, some of it's warranted, right? A lot of these businesses, especially some of these software companies, have probably got a boost from COVID and more of a work at home environment, learn from home environment, and that's fair. But their stock prices seem to have gotten a little bit ahead of themselves. They seem to be pricing in a little bit more than what the more improved prospects would warrant. So we stay away from them. A very important pillar of ours is valuation. So we're looking for these wonderful businesses, but we're not going to pay too much for them. So So that's kind of naturally led us to some areas of the market that have been overlooked. So a couple of examples is we've made some investments in a couple businesses that have exposure to commercial real estate market. Right, so this is a more kind of old school economy, value-y type of industry that's very out of favor right now. Right, work from home is a real trend that's probably going to be more prevalent than it was pre-COVID, but commercial real estate's not going away. You know, and the businesses that we look to invest in, for example, one is a leader in commercial interior ceiling tile. And another one is by far the leader in commercial roofing, replacement roofing. And these are businesses that are very high quality. They are dominant number one players in their industries, have very strong competitive advantages. It's very hard to compete with these people. They're entrenched. Customers love them, and they're very profitable. But the market's ignoring this. They're not popular. They're not the hot stocks right now. But these are businesses that are trading, a couple of them we bought at kind of low to mid-teens type PE ratios when the market's trading at 18, 20 times. And they're still wonderful businesses, have great management teams with great capital allocation plans. And the value will be recognized. We're patient as they keep producing good cash flow and producing their earnings. We believe the market will recognize the value. So that's some of the areas where we've been hunting in and kind of moving the portfolio more in that direction based on the opportunities that presented themselves.
So I want to pause here, and I know Andy's thrown a lot at you guys. And again, at this point, we don't want to waste your time. We want to make sure we're answering all of your questions. Do you have any specific questions that you would like us to cover regarding either the market, anything individually, stock, or just asking what do we think? Like, a lot of this is kind of just open to your discussion. We can get into the weeds. I understand that, and I don't know if you guys want to go there, but I'd like to at least open it up to everyone to just see if you'd have any more specific questions that you'd like us to cover.
All right, commissioners or Jamie, any questions?
Good.
Okay.
Okay.
I think we're good.
Okay.
Running.
Well, Andy, I know you've given a great update on the market, but I just want to sum up again, just what we're trying to, I guess, get across with our strategy is we are not going to be targeting high flyers, high risk. That is one thing I want to make sure that is clear in this particular, in this Zoom conference. We are going to be a fairly conservative core mid-cap manager. Now, again, as we were alluding to earlier, when you have a risk-on environment where some of these stocks are valued at 40% over the S&P, this is when we are not going to perform like those guys, period. And we're fine with that. So we need to make sure that you guys are okay with that because we are the more conservative option. But that doesn't mean again, who knows when it's going to happen, but if there is a market turn, this is why you own us. This is why you have that more conservative protection option, which is the Madison mid-cap strategy. So I just wanted to make sure that came across.
Thanks, Chris.
Good. Thank you so much for your time. Thanks for allowing us to present to you. Chris, thanks to you and Andy and commissioners and board. Thank you very much for your time.
Excellent.
Thank
Thank
you.
you all.
Thank you.